Every 4 years, America elects a president, and every 4 years something remarkable happens in the stock market. Not always obvious, not always perfect, but consistent enough that a Wall Street historian named Yale Hirsch noticed it back in 1967 and turned it into one of the most enduring patterns in financial markets. He called it the presidential election cycle, and historical data suggests it's been operating with surprising reliability since 1928. The pattern is simple but powerful. Markets behave differently depending on which year of the presidential term we're in. Year 1 tends to be weak as new presidents implement policies that rattle investors. Year 2 is historically the worst, marked by midterm election uncertainty and legislative gridlock. Year 3 surges higher as presidents stimulate the economy to boost their re-election chances, and Year 4 delivers moderate gains as voters head back to the polls. This isn't political theatre. This is pattern recognition backed by nearly a century of market data. And if you understand how this cycle works, you gain a timing advantage that most investors never recognize. Let me show you how markets have behaved in each year since 1928, which presidents broke the pattern, and why Year 3 has been the most profitable moment in every 4-year cycle for almost 100 years. In 1967, Yale Hirsch published the first edition of something that would become a Wall Street institution. He called it the Stock Trader's Almanac, and it was different from anything investors had seen before. Hirsch wasn't interested in predicting tomorrow's market move or picking the next hot stock. He was interested in patterns that repeated across decades. He organized market data on a calendar basis and discovered something that should have been obvious but somehow nobody had documented. Markets moved in predictable cycles tied to political events. The January barometer, which suggested that January's performance predicted the year ahead. The Santa Claus rally, which showed that markets tended to rise in the final trading days of December. The best 6-month strategy, which demonstrated that markets gained most of their annual returns between November and April. But perhaps Hirsch's most significant discovery was the presidential election cycle. He noticed that stock market returns followed a distinct pattern across every president's 4-year term, regardless of which party held power. This wasn't about Republicans versus Democrats. This was about timing within the presidential cycle itself. Hirsch's research went back several decades, and what he found was striking. The first year after a presidential election typically saw weaker performance as the new president focused on implementing campaign promises. These promises often involved policies that created uncertainty for markets. Higher taxes, new regulations, changes to trade policy. Whatever the specifics, the first year of a presidential term historically involved the president pursuing their core agenda rather than worrying about popularity or re-election. The second year was even worse. This was the midterm election year, when all 435 House seats and about 1/3 of Senate seats were up for grabs. Markets historically struggled during this period, characterized by increased volatility and weak returns. The uncertainty wasn't just about which party would control Congress. It was about what that would mean for the legislative agenda, for spending priorities, for the ability of the president to pass major bills. The third year was where the pattern became most compelling. Historical data suggested that the third year of the presidential cycle produced the strongest returns. The logic behind this was straightforward. By Year 3, the president was thinking about re-election. Whether seeking a second term themselves or hoping to secure victory for their party's next candidate, presidents historically focused on stimulating the economy during Year 3. They pushed for pro-growth policies. They encouraged the Federal Reserve to keep conditions accommodative. They avoided controversial moves that might upset voters. The result was that markets historically surged during pre-election years. The fourth year, the election year itself, showed moderate performance. Markets typically gained during election years, but not as dramatically as Year 3. The uncertainty around the election outcome created some volatility, but historical patterns suggested that once the election was over, markets usually rallied regardless of which party won. When Hirsch first documented this pattern in the Stock Trader's Almanac, it was based on data going back to the 1800s, but for our purposes, we're going to focus on the period from 1928 forward, because that's when the S&P 500's predecessor indices began providing consistent data that researchers still use today. From 1928 through 2024, we have 96 years of market history covering 24 presidential election cycles. That's enough data to see whether the pattern holds, where it breaks down, and what it means for investors trying to position themselves advantageously within the cycle. Let me walk you through what the numbers actually show. When researchers have analysed S&P 500 returns across these 24 cycles, they've found that the pattern Hirsch identified does appear in the historical data, though not with mathematical perfection. According to research published by multiple financial institutions analysing data from 1950 through 2024, the S&P 500 has averaged returns of approximately 7.9% during the first year of presidential terms. That's below the long-term average annual return of roughly 10%. The second year, the midterm year, has historically been even weaker, around 4.6% average returns. Some studies using data from the Dow Jones Industrial Average going back to 1896 show even lower numbers for midterm years, at roughly 4%. The third year is where the pattern becomes dramatic. Historical data indicates that pre-election years have averaged returns of approximately 17.2%, nearly double the long-term average. Looking at data from 1950 through 2023, the third year of the presidential cycle saw positive returns 90% of the time. That's significantly higher than the 70% positive rate for all years combined. The fourth year, election year itself, has historically shown average returns of about 7.3%, slightly below the long-term average but still positive more than 80% of the time. These aren't just numbers on a spreadsheet. These patterns represent actual money flowing into and out of markets, based on political cycles that have repeated across nearly a century. And the consistency of year 3 outperformance is what makes the presidential election cycle theory compelling to professional investors. Since 1928, according to data compiled by financial research firms, election year returns for the S&P 500 have averaged around 11.3%, with 83% of election years producing positive returns. Only 4 election years since 1928 have produced negative returns. 1932, down 1.4% during the Great Depression. 1940, down 4.7% as World War II began in Europe. 2000, down less than 1% as the dot-com bubble burst. And 2008, down 37% during the financial crisis. Every other election year going back to 1928 saw stocks rise. But it's the year-by-year breakdown across the full cycle that reveals the true power of the pattern. Let me take you through what historical data suggests happens in each year, starting with year 1, the post-election year. When a new president takes office or an incumbent begins their second term, markets historically experience what some analysts call implementation uncertainty. The new administration begins pursuing its agenda. If it's a first-term president, they're fulfilling campaign promises. If it's a second term, they're pursuing legacy items they didn't get to in the first 4 years. This creates uncertainty for investors because policy changes affect different sectors differently. A president focused on environmental policy might boost renewable energy stocks but hurt fossil fuel companies. A president pursuing tax reform might help certain industries while hurting others. Markets don't necessarily hate all policy changes, but they do historically react poorly to uncertainty about what those changes will be. Looking at specific examples, historical patterns show some fascinating variations. When Richard Nixon took office in 1969, the S&P 500 fell 8.5% that year. When Jimmy Carter became president in 1977, markets fell 7.2%. When Ronald Reagan took office in 1981, the market declined nearly 5%. These declines fit the traditional pattern of weak first-year performance. But here's where it gets interesting. The pattern started breaking down in more recent decades. When Bill Clinton took office in 1993, markets rose nearly 10% in his first year. When George H.W. Bush started his term in 1989, stocks climbed over 27%. When George W. Bush became president in 2001, markets fell 13%, but that was primarily due to the bursting dot-com bubble rather than presidential policy. When Barack Obama took office in 2009, in the depths of the financial crisis, markets surged 23.5% in his first year. This was the opposite of what the traditional pattern predicted. When Donald Trump took office in 2017, the S&P 500 rose 19%, again contradicting the weak first-year expectation. And when Joe Biden took office in 2021, markets gained 27%. What changed? Why did the pattern that held for decades start breaking down in the late 20th century? Some market analysts suggest that Federal Reserve policy became more important than presidential policy in determining market direction. When Obama took office, the Fed was engaged in unprecedented monetary stimulus to combat the financial crisis. Markets rose not because of what Obama was doing, but because the Fed was flooding the system with liquidity. When Trump took office, the economy was already in a strong expansion, and his promises of tax cuts excited investors. The first-year weakness predicted by the presidential election cycle theory didn't materialize because other factors overwhelmed the typical political dynamics. This is an important lesson about using historical patterns. They provide a framework for understanding typical behavior, but they're not laws of physics. Markets respond to whatever is the dominant force at any given moment. Sometimes that's presidential policy, sometimes it's Federal Reserve action, sometimes it's a global pandemic or a financial crisis. The pattern describes what typically happens when normal conditions prevail, but abnormal conditions can override the pattern entirely. Year 2, the midterm election year, shows more consistency with the historical pattern. This is typically the weakest year of the presidential cycle, and the data bears that out fairly reliably. Midterm elections occur every 2 years, putting all 435 House seats and roughly 1/3 of Senate seats up for election. Historical patterns suggest that the president's party usually loses seats during midterm elections. Since World War II, the president's party has lost an average of about 26 House seats during midterm elections. This creates a political dynamic where the president often faces a more hostile Congress after the midterms, making it harder to pass legislation. Markets historically haven't liked this uncertainty. During the 12 months leading up to midterm elections, S&P 500 returns have averaged just 0.3% going back to 1962, according to research from major banks. That's far below the 8.1% historical average for all years. But here's the fascinating part. Markets have historically performed dramatically better after midterm elections than before them. In the 12 months following midterm elections, the S&P 500 has averaged returns of 16.3%, double the normal rate. And remarkably, historical data shows that the S&P 500 has not experienced a negative 12-month return following any midterm election since 1946. That's over 75 years of consistently positive performance in the year after midterms. Looking at specific midterm years reveals the pattern clearly. In 2002, the second year of George W. Bush's first term, the S&P 500 fell 22% as the tech bubble continued deflating. In 2010, the second year of Obama's first term, markets rose about 13% as they recovered from the financial crisis lows. In 2018, the second year of Trump's term, markets fell 6% as the Fed raised interest rates. And in 2022, the second year of Biden's term, markets fell more than 18% as inflation surged and the Fed aggressively hiked rates. These examples show that midterm years often do experience weakness or heightened volatility, consistent with the historical pattern. But they also show that the causes vary. Sometimes it's genuine political uncertainty. Sometimes it's economic factors that happen to coincide with the midterm year. The 2022 example is particularly instructive. Markets fell sharply that year, but was it because of the midterm elections? Or was it because inflation hit 40-year highs and the Federal Reserve raised interest rates at the fastest pace in decades? Most analysts would say the Fed and inflation were far more important than the political calendar, but the political calendar provided the framework within which these economic events unfolded. The third year, the pre-election year, is where the presidential election cycle theory becomes most compelling because the historical outperformance is so dramatic and so consistent. Going back to 1928, researchers have found that the third year of presidential terms has produced positive returns, approximately 78 to 90% of the time, depending on which dataset you examine. The average return during third years has been around 13.5 to 17.6%, roughly double the long-term average. Between 1950 and 2023, only 2 third years out of 23 produced negative returns. That's an astonishing consistency that few other market patterns can match. Why does this happen? The conventional explanation is that presidents, regardless of party, focus on stimulating the economy during the pre-election year to improve their chances of winning re-election or helping their party's candidate win. This is sometimes called the political business cycle theory. Presidents push for spending increases. They encourage the Fed to keep monetary policy accommodative. They avoid controversial decisions that might upset voters or hurt the economy. The result is an environment where economic growth tends to accelerate, corporate profits tend to rise, and stock markets tend to perform strongly. Looking at specific third years reinforces the pattern. In 1995, the third year of Clinton's first term, the S&P 500 rose 34%. In 1999, the third year of Clinton's second term, stocks surged 19% at the peak of the dot-com boom. In 2003, the third year of George W. Bush's first term, markets rose 26% as they recovered from the tech crash and 9/11 attacks. In 2007, the third year of Bush's second term, markets gained 3.5%, one of the few modest third-year performances, and notably this was the year before the financial crisis. In 2011, the third year of Obama's first term, stocks were essentially flat, another exception to the pattern, as Europe's debt crisis created uncertainty. In 2015, the third year of Obama's second term, markets fell slightly as China's economy slowed. In 2019, the third year of Trump's term, stocks surged 28.9% despite ongoing trade tensions with China. And in 2023, the third year of Biden's term, markets rose over 24% as artificial intelligence excitement drove tech stocks higher. The pattern shows remarkable consistency, with most third years producing strong double-digit gains. The exceptions, like 2011 and 2015, occurred when external crises overwhelmed the normal political dynamics. But even with those exceptions, the third year has historically been the best year of the presidential cycle by a significant margin. This creates a compelling opportunity for investors who understand the pattern. If historical trends continue, and that's always a significant if, then investors might consider increasing their equity exposure as the third year approaches and reducing it as the third year ends. This isn't market timing in the traditional sense of trying to predict day-to-day or month-to-month moves. It's cycle, positioning based on patterns that have repeated for nearly a century. Of course, past performance doesn't guarantee future results, and the pattern could break down in any given cycle. But the historical consistency of third-year outperformance is strong enough that professional investors and strategists pay attention to it when making allocation decisions. The fourth year, election year itself, shows more moderate performance but still tends to be positive historically. As I mentioned earlier, 83% of election years since 1928 have produced positive returns, with an average gain of about 11%. Election years bring their own form of uncertainty. Voters must choose between candidates with different policy platforms, and markets must price in the potential impact of those platforms. You might expect markets to perform very differently depending on whether a Republican or Democrat wins, but historical data doesn't strongly support that assumption. According to research analyzing returns from 1928 through 2016, when a Republican won the presidency, the average return for that election year was 15.3%. When a Democrat won, the average return was 7.6%. Republicans won 13 of those 23 elections. Democrats won 10. The difference in returns is noticeable but not enormous, and it doesn't account for all the other factors affecting markets during those years. More importantly, when you look at full presidential terms rather than just election years, the data becomes even more interesting. From 1933 through 2020, markets have averaged gains during both Democratic and Republican administrations. The long-term trend has been upward, regardless of which party held the White House. What seems to matter more than which party wins is simply that the election is over and uncertainty is resolved. Historical patterns suggest that markets often rally in the months immediately after an election, once investors know who will be setting policy for the next 4 years. This post-election rally has occurred after elections won by both parties. It's not the party that matters, it's the removal of uncertainty. There's another fascinating aspect of election year performance. Research has shown that the stock market's performance in the 3 months before an election has historically correlated with whether the incumbent party wins or loses. Since 1928, when the S&P 500 rose in the 3 months before Election Day, the incumbent party won 87% of the time. When the market fell during those 3 months, the challenger won 80% of the time. This makes intuitive sense. If the economy is doing well enough that markets are rising, voters tend to reward the party in power. If the economy is struggling and markets are falling, voters tend to vote for change. Presidents understand this dynamic, which is another reason why they tend to focus on economic stimulus during the pre-election year. They want the economy to be strong by the time voters head to the polls. Now let me address something crucial about the presidential election cycle theory. It's become less reliable in the 21st century, and several researchers have noted this. The pattern that worked fairly well from the 1920s through the 1990s has shown increasing exceptions since 2000. First-year performance, which was supposed to be weak, has often been strong in recent administrations. Obama's first year saw a 23% gain. Trump's first year saw a 19% gain. Biden's first year saw a 27% gain. These contradict the traditional pattern. Similarly, second years haven't always been the weakest. Some midterm years have produced solid gains even before the midterm elections themselves, and while third years have generally maintained their historical outperformance, the margin hasn't been as dramatic in every cycle. What changed? Several factors seem to be at play. First, Federal Reserve policy became more dominant in driving market returns, particularly after the 2008 financial crisis. The Fed's quantitative easing programs, which pumped trillions of dollars into the financial system, overwhelmed normal political cycles. When the Fed is creating money and buying assets on a massive scale, markets tend to rise regardless of what year of the presidential cycle we're in. Second, markets became more global. US stocks are increasingly influenced by events in China, Europe, and emerging markets. A president's domestic policy matters less when global forces are the primary driver of corporate earnings and market sentiment. Third, technology disrupted traditional patterns. The rise of tech giants that operate globally, the increasing dominance of passive index investing, and algorithmic trading all changed how markets function. These structural shifts may have weakened the influence of the political cycle. Despite these caveats, the presidential election cycle remains a useful framework for understanding market behavior, even if it's not a perfect predictive tool. Think of it as one factor among many that influences market returns. It's not the only factor, and it's not always the dominant factor, but it does appear to exert an influence that shows up in long-term averages, even if individual cycles vary. Professional strategists still reference the presidential cycle when making forecasts and allocation recommendations. When firms like JP Morgan, Morgan Stanley, or Goldman Sachs publish their annual outlook, they typically mention which year of the presidential cycle the coming year represents and what that might mean for returns. They don't base their entire forecast on the cycle, but they incorporate it as part of their analysis. Let me give you some additional context about why third-year outperformance specifically has been so consistent. There's a concept in political science called the political business cycle, which suggests that politicians manipulate economic policy to create favourable conditions before elections. This isn't necessarily cynical or manipulative in a negative sense. It's simply recognition that politicians respond to incentives, and the strongest incentive is winning re-election. If you're a president heading into your third year, you know that the economy's performance in years 3 and 4 will heavily influence the election outcome. So you push for policies that will boost economic growth, create jobs, and increase consumer confidence. You might increase government spending on popular programs. You might push for tax cuts that put more money in voters' pockets. You might pressure the Federal Reserve, at least rhetorically, to keep interest rates low and credit conditions easy. You might delay controversial regulations that could hurt business confidence. You might pursue trade policies that benefit key voting constituencies. All of these actions tend to create an environment where corporate profits grow, employment rises, consumer spending increases, and stock markets perform well. The president isn't directly controlling stock prices, but they're creating conditions that tend to support higher valuations. Historical data also shows an interesting pattern, with divided versus unified government. When one party controls both the White House and both chambers of Congress, you might expect markets to perform better, because the president can more easily pass their agenda. But research suggests the opposite. Markets have historically performed better when government is divided, when different parties control different branches. The average annual return when Congress is split between parties has been around 14.9%, according to some studies. When one party controls both chambers, returns have averaged around 8%. And the scenario that many investors assume would be worst, when the president's opposition party controls Congress, has actually produced average returns of 7.4%. Why would divided government produce better returns? One theory is that investors prefer gridlock. When government is divided, neither party can pass sweeping legislation that might dramatically change the business environment. This creates stability and predictability, which markets generally prefer over uncertainty. Another theory is that divided government forces compromise and moderation. Bills that do pass tend to have bipartisan support, and therefore are less likely to be extremely liberal or extremely conservative. This moderate approach is generally market-friendly. There's also the question of whether investors should actually try to time their investments based on the presidential cycle. The theory suggests that you might want to reduce equity exposure during first and second years, then increase exposure during third years, then perhaps take some profits during the fourth year. But implementing this strategy faces several challenges. First, transaction costs and taxes reduce returns when you trade frequently. Moving in and out of positions generates capital gains, taxes, and brokerage fees. Second, the exceptions to the pattern can be costly. If you reduce exposure during a first year that happens to produce strong returns, like Obama's or Trump's or Biden's first years, you miss out on significant gains. Third, other factors often overwhelm the cycle. If you're in cash during a first or second year because the cycle suggests weakness, but the Fed is engaged in massive monetary stimulus that drives markets higher, you've missed a major rally by following the pattern. Fourth, the pattern describes averages over many cycles, but your investing career might only span a few cycles. If the pattern happens to break down during the specific cycles you're invested, the historical average doesn't help you. For these reasons, most professional advisors suggest using the presidential cycle as context for understanding potential market behavior rather than as a rigid timing signal. You might tilt your allocation slightly, perhaps overweighting equities by a few percentage points during year 3, but you wouldn't make dramatic all-in or all-out moves based purely on the cycle. Let me walk through what the complete picture looks like when you combine everything we know about the presidential election cycle. Based on data from 1928 through 2024, here's what historical patterns suggest investors might typically experience over a 4-year cycle. Year 1 brings policy uncertainty as a new administration implements its agenda. Average returns historically ran below the long-term average, though this pattern has weakened in recent decades. Volatility tends to be moderate. The first several months after inauguration are when most policy changes occur, so that's typically when uncertainty peaks. By the second half of year 1, markets often stabilize as investors adapt to the new policy environment. Year 2, the midterm year, has historically been the weakest and most volatile. Markets often struggle in the months leading up to the midterm elections in November. Volatility picks up as investors worry about potential shifts in congressional control. But remarkably, once the midterms are over, markets have historically rallied strongly, regardless of which party won. The year following midterm elections has never produced a negative 12-month return since 1946, making the post-midterm period one of the most reliable positive periods in market history. Year 3 is when the pattern becomes most favorable. Presidents focus on stimulating growth to set up favorable conditions for re-election. Fiscal and monetary policy tend to be accommodative. Controversial decisions are delayed. The result has historically been strong double-digit returns in most cycles, with the third year producing positive returns roughly 90% of the time. This is the year when investors have historically wanted maximum equity exposure if they're following the cycle. Year 4, election year, brings moderate returns on average but with considerable variation depending on the specific circumstances. The first half of election years has historically shown sluggish performance as investors wait to see who will win. The third quarter has historically been the strongest period of election years. Once the election is over in November, markets typically rally through year-end regardless of who won, as uncertainty is replaced by clarity about the policy direction for the next 4 years. Understanding these patterns doesn't mean you should overhaul your entire investment strategy based on what year of the cycle we're in. But it does provide useful context. If you're in year 2 and markets are struggling, you can recognize that this fits the historical pattern and might present a buying opportunity rather than a reason to panic. If you're in year 3 and markets are soaring, you can enjoy the gains while recognizing that year 4 might bring more moderate returns, so you might want to rebalance rather than chase performance. If you're in year one and policy uncertainty is creating volatility, you can understand that this is normal for the cycle and that historically things tend to improve as the cycle progresses. The presidential election cycle theory is ultimately about recognizing that political incentives create predictable patterns in how presidents manage economic policy, and those patterns tend to influence market behavior in ways that show up across decades of data, even if individual cycles vary considerably. Let me address one more aspect that's particularly relevant for investors trying to use this information. Within each year of the presidential cycle, there are specific months and quarters that have historically performed differently. Research examining quarterly performance across the cycle from 1950 through 2024 shows some fascinating patterns. During year one, the first quarter has historically been the weakest, with average returns below normal. This makes sense because the first quarter is when the new president is implementing the most disruptive policy changes. The second and third quarters of year one have shown more typical returns. The fourth quarter has often been strong as markets adapt to the new administration and look forward to year two. During year two, the pattern is more dramatic. The first quarter has shown roughly average returns. The second quarter has been weak, with below average performance. The third quarter, leading into the midterm elections in November, has been the weakest period of the entire 4-year cycle, with average returns significantly below normal. But the fourth quarter, after the midterms are over, has historically produced some of the strongest returns of the entire cycle as markets rally in relief once election uncertainty is resolved. During year three, nearly every quarter has historically outperformed. The first quarter has been strong. The second quarter has been very strong. The third quarter has produced above-average returns. The fourth quarter has been solid, though sometimes showing slightly weaker performance as markets begin to worry about the upcoming election year. During year four, the election year, the pattern within the year is particularly interesting. The first and second quarters have historically shown sluggish performance as investors wait to see who will win the election. August has historically been the strongest month of election years, with average gains around 3% and positive returns in more than 70% of election years. September and October, the 2 months before the election, have shown more volatility with mixed performance. November, the month of the election, has historically been strong as uncertainty resolves. December typically ends the year on a positive note with the Santa Claus rally that Hirsch also documented. These intra-year patterns within the broader 4-year cycle add another layer of timing information for investors who want to fine-tune their approach. But again, the caveats apply. These are averages across many cycles, individual years vary dramatically, and other factors often matter more than the political calendar. The presidential election cycle theory works best as a framework for understanding typical behavior, rather than as a precise timing tool for making trade decisions. Now, let me bring this forward to the present moment and what it might mean for investors looking ahead. As of 2024, we completed year 4 of Joe Biden's term, an election year that saw Donald Trump elected to return for a second term beginning in January 2025. If the historical pattern holds, 2025 as year 1 of Trump's second term might see below average returns as policy uncertainty rises during the implementation phase. But as we discussed, recent first years have often contradicted this pattern, producing strong gains instead. 2026 would be year 2, the midterm year. Historical patterns would suggest this could be volatile and potentially weak in the months leading up to the November 2026 midterm elections, but strong in the months after the elections. 2027 would be year 3, the pre-election year. If history is any guide, this would be the year to expect the strongest performance as Trump's administration focuses on creating favorable economic conditions heading into the 2028 election. 2028 would be another election year, with Trump constitutionally barred from seeking a third term, meaning an open field for both parties. Research has shown that election years without an incumbent president running tend to show weaker returns than years when an incumbent seeks re-election. But here's the crucial point. While these historical patterns provide a framework, the actual outcomes will depend on factors we can't predict today. Where will inflation be? What will the Federal Reserve be doing with interest rates? Will there be a recession? Will there be a geopolitical crisis? Will technological disruption accelerate or slow? Will valuation levels be stretched or reasonable? All of these factors will influence returns far more than which year of the political cycle we're in. The presidential election cycle theory is most useful when markets are operating under relatively normal conditions without major external shocks. During periods of crisis like 2008 or 2020, the cycle becomes almost irrelevant as investors focus on survival rather than political timing. During periods of extreme monetary stimulus, like the years following the financial crisis, Fed policy overwhelms the political cycle. During periods of major technological disruption, like the artificial intelligence boom of 2023 and 2024, innovation and growth opportunities matter more than election timing. For individual investors, the takeaway from understanding the presidential election cycle isn't that you should radically alter your investment approach based on what year we're in. The takeaway is that you should recognize politics as one of several cyclical forces that influence markets over time. Just as there are seasonal patterns like the tendency for stocks to perform better from November through April than from May through October, there are political patterns like the tendency for year 3 to outperform the other 3 years of the cycle. These patterns don't work perfectly every time, but they work often enough over long periods to be worth understanding. They help you contextualize what's happening in markets at any given moment. If markets are struggling during a midterm year, you can recognize that this fits a pattern rather than assuming something uniquely terrible is happening. If markets are surging during a pre-election year, you can enjoy it while recognizing that it also fits a historical pattern that might not continue forever. The pattern provides guardrails for expectations rather than precise predictions of what will happen. Yale Hirsch, the man who discovered and documented the presidential election cycle, passed away in 2021 at the age of 98. The Stock Trader's Almanac that he created in 1967 continues to be published annually under the leadership of his son Jeffrey Hirsch, who has maintained his father's work while updating it with new data and analysis. The 1967 first edition introduced concepts that are now widely accepted in the financial industry: the presidential cycle, seasonal, patterns, the January barometer, and numerous other calendar-based phenomena that influence market behavior. Hirsch's work represented a different approach to market analysis. Rather than trying to predict what would happen tomorrow or next week based on news flow and sentiment, he looked for patterns that repeated across decades. This long-term historical approach revealed cycles that short-term analysis missed. The presidential election cycle was perhaps his most enduring discovery because it connected politics and markets in a way that made intuitive sense and was backed by decades of data. Presidents respond to political incentives. Those incentives change predictably across the 4-year election cycle, and those changing incentives influence economic policy in ways that affect market returns. It's a straightforward theory that happens to be supported by substantial historical evidence. As we think about applying this knowledge, it's worth remembering that the theory is now 58 years old, dating back to 1967. Markets have changed enormously since then. The technology sector barely existed in 1967 and now dominates the S&P 500. International investing was rare in 1967 and now represents trillions of dollars in capital flows. The Federal Reserve was a far less powerful and activist institution in 1967 than it became after the 2008 financial crisis. Passive index investing was essentially unknown in 1967 and now represents the majority of equity fund flows. All of these structural changes might be weakening the presidential election cycle's influence on markets, and yet, the pattern still shows up in the data. Year 3 still produces the strongest returns on average. Midterm years still show weakness before the elections and strength after. Election years still tend to be positive. The pattern has proven resilient even as markets have evolved. Perhaps that's because the underlying driver, political incentives, hasn't changed. Presidents still want to be re-elected or to see their party succeed. They still have the most policy flexibility in their early years and the most focus on short-term economic performance in their late years. As long as these political realities persist, the presidential election cycle is likely to continue influencing market behavior to some degree, even if other factors sometimes overwhelm it. For investors looking to position themselves based on the cycle, the key is to think in terms of probabilities rather than certainties. Historical data suggests that certain years of the cycle tend to produce better returns than others, but tend to is different from always do. You're playing the odds, not following a formula. The odds historically favour equities during year 3. The odds are more neutral during years 1 and 4. The odds are somewhat against equities during year 2, at least until after the midterm, elections. But odds are just odds. Any individual cycle can deviate from the average. What matters is whether you want to tilt your allocation slightly to take advantage of historical patterns, while recognising that those patterns could break down in any given instance. Most professional investors who pay attention to the presidential election cycle use it as one input among many in their decision-making process. They don't ignore it, but they don't blindly follow it either. They look at valuations, they look at earnings growth, they look at Federal Reserve policy, they look at global economic conditions, and they also look at where we are in the political cycle. All of these factors combine to inform their view on whether to be overweight or underweight equities at any given moment. The presidential election cycle reminds us that markets don't exist in a vacuum. They're influenced by the political environment, by the incentives facing elected officials, by the policy choices those officials make, and by the economic consequences of those choices. Understanding this connection between politics and markets is part of understanding how financial markets actually work in the real world. It's not just about earnings and interest rates and technical analysis. It's also about power and incentives and the ways that political actors respond to the electoral calendar. The fact that this pattern has persisted for nearly a century, through wars and depressions and booms and busts, through Democratic and Republican administrations, through periods of high inflation and low inflation, through financial crises and technological revolutions, suggests that it captures something fundamental about how American democracy and capitalism interact. As long as we have 4-year presidential terms, as long as we have midterm elections at the 2-year mark, as long as presidents face incentives to stimulate the economy before elections, the presidential election cycle is likely to continue exerting at least some influence on market behaviour. That's the power of pattern recognition in markets. You're not predicting the future with certainty. You're recognising that certain conditions tend to produce certain outcomes more often than chance would suggest. The presidential election cycle is one of the most robust patterns in American financial markets, backed by 96 years of data across 24 presidential cycles. It's not perfect, it doesn't work every time, and it's certainly not the only factor that matters. But it works often enough and consistently enough that investors who understand it have a timing advantage over those who don't. They can recognise when markets are behaving according to the pattern and when something else is dominating. They can position themselves to take advantage of the historically strong year 3 returns, while being more cautious during the typically weak midterm years. They can understand that market behaviour isn't random, that there are cycles and patterns that repeat, and that political incentives are one of the forces creating those patterns. If understanding the presidential election cycle changes how you think about market timing and gives you confidence that there are knowable patterns beneath what often seems like chaos, if you recognise that politics and markets interact in predictable ways that have repeated for nearly a century, then you're starting to see markets the way professional strategists do. Not as a casino where anything can happen at any moment, but as a complex system with cycles and patterns that can be identified and potentially exploited. The presidential election cycle isn't a crystal ball, but it is a map. It shows you where you are in the political and market cycle at any given moment. It tells you what has typically happened at this point in the cycle historically, and it gives you a framework for understanding whether current market behaviour is typical for this point in the cycle, or whether something unusual is occurring that might represent either an opportunity or a risk. Subscribe to Cycle Chronicles if you want to keep exploring the patterns that drive markets and economies, because while they won't teach you about the presidential election cycle in business school or economics classes, these patterns are how money actually changes hands over time. The cycle has been operating since 1928. It operated through every boom and bust of the 20th century, and historical data strongly suggests it's still operating today. The question is whether you're going to recognise the pattern and position accordingly, or whether you're going to wonder why the market surged in the pre-election year while you sat in cash, or why the midterm year was volatile while you weren't prepared for it. Pattern recognition separates those who understand how markets work from those who are just guessing. The presidential election cycle is one of the most reliable patterns we have. Now you know it exists, you know how it works, and you know what history suggests happens in each year of the cycle. What you do with that information will determine whether you're positioned on the right side of the pattern when it matters most.